What happened, you can see June of, I don't have a pointer, but you can see June, that big dip in June of 2019. You remember what happened in 2018, a great year, good year, like very strong flatbed rate rally for the first 7 months, then the wheels kind of fell off, but everyone went out and bought new trucks and trailers in the third quarter. And that hangover, was right through into 2019. Demand flattened, and rates went on this steady decline for nearly all of 2019, and they were still heading down until the pandemic. But all that capacity from 2018 came on the road in 2019, and you saw downward pressure on rates. It was unsustainable for a lot of carriers, and they went out of business. June of 2019, that quarter, was when you saw some of the big fleets go out of business. Some really big names disappeared, but we had a lot of small businesses vanish also. The upward inflection on that black line is when PPP loans ended and diesel prices went down to about $2.40, if I remember, as a national average. And that period of time in the second half of 2020, where spot rates went up and diesel went down, generated some of the biggest profits that carriers have seen in decades. And if you'd have been listening to me on the shows that we're on, Sirius XM, our Tuesday DATIQ show, I was saying one thing: these rates won't last, and put money away for that rainy day. I was like a broken record when rates were going up and up and up. Well, the rainy day's here, and a lot of carriers didn't listen, right? They didn't put money away, paid too much for used trucks, and high insurance as a new entrant, all those sorts of things working against them when rates went down. The point is that at its peak in June of 21, we were adding about 8,000 net new carriers a month. There's a lot of people coming into this, a lot of people with hotshot trailers, small trucks, lift gates, long-haul carriers. There was a lot of capacity came into this industry, and we saw record high spot rates. You could almost name your price to move some of this freight. Capacity was so tight. We were also shipping a lot of air, because shippers were moving whatever they could whenever they could get a truck, even if it wasn't full. We were shipping a lot of air, right? And when the fuel surcharge went up in February last year, shippers automatically put the brakes on and said, let's fill those trailers. So your volume dropped. But we had all these trucks still. And after the Russian invasion of Ukraine and diesel prices went up, we started this steady decline in profitability because rates started to tank, and diesel prices started to go up. They hit $5.80 as national average in the middle of the summer, right? And that really put the squeeze on everybody that had joined the industry. That black line above the centre line, that's the extra capacity that some of it's still in the industry now, right? And there's carriers struggling right now with some of the economics. There were two periods last year when we saw a lot of carriers leave the business, May and June, when the cash flow crunch from high diesel prices hit, and then October, November. And you can see the two downward drops there on that chart. They were the two periods where we saw a lot of carriers struggle. Since then, we've gone negative. That means in the interstate sector, we are losing more interstate carriers than we're adding. Whenever that black line's below the centre line, we're losing capacity in the interstate category. So this is as of last week. I pulled it last Sunday. We are coming back out of that trough. So we were losing about 3,000 carriers a month from October to end of January, and you can see it's flatline and it's coming back up. So what does that mean? It means that we're not losing capacity at the rate we were, and we're starting to get back to carriers coming back into the industry. And some of you might say, what the heck are they looking at? Because things aren't too good if you're in the freight business, right, with some of the rates, unless you've got a good mix of contract and spot. So that is why we are at where we are today. We've got way more capacity than we have demand. There's more trucks than loads because of that big spike in that black line. That's the supply and demand reality of what we face today, right? We've just had a lot of carriers come into the business. Unfortunately, a lot of carriers didn't understand their operating costs either. Again, we've been like a crack record on this subject about operating costs. I've written so many blog posts on how to understand your operating costs, put money away for a rainy day, make sure you got that in-frame rebuild socked away, because these used trucks that you're running with all these emissions on them are not going to last. And you're going to get stung with your operating costs way above where they need to be. Anyway, that's kind of where we're at with the supply and demand piece. If you said, so think about the market in two sections, contract freight and spot freight. Spot freight is about 15% of all the loads moved. 85% of the loads moved every day are on contract rates. It's a pre-negotiated rate that's used over and over and over every day for hundreds and hundreds of loads on a lane. That's the contract rate. I'll show you what they're doing right in a minute. Spot rates, though, we're seeing more volume in the spot market, though. Even though spot volumes are down and the rates are down, shippers are pushing more volume to the spot market this year. They haven't done that before. Instead of sending it to the asset carriers and then it gets rejected and falls through the routing guides and out into the broker market, they're deliberately bypassing that tender process through EDI, shipping it direct to a broker for a managed spot market buy. So they control their spot purchase rather than getting ripped a new one on Friday afternoon when there's no trucks. You know how that goes. So what they realised was they got absolutely taken to the cleaners in the last couple of years. And shippers said, you know what, we can't afford that again because some of them went out of business because they paid too much for purchase transportation. So they said, let's be more strategic about this. So that's sort of the big picture. I am probably going to run out of time and I'm going to do my best I can to get through what we need to listen to today. And if we miss it, come outside to my truck and I can get my laptop out and we can go even further with it, all right? So, demand. What's the demand for what you haul, right? There's one thing you've got to know, and that is whatever you haul, you've got to know who's buying it and how much and what the seasonality is. That's like table stakes. If you've got to read anything, read what it is that you haul. Understand everything there is about that. That's the demand piece. ATA truckload tonnage is mostly about the contract freight, not DAT spot, right? Bob Costello will tell you that volumes were up in February, kind of been sideways for the last 3 months, but we're up about 2.5% year over year compared to February last year. A little bit more tonnage moving in the contract market, less in the spot. So that's a good thing, right, that we've got relatively flat demand. If you look at the amount of volume moving in spot, it has decreased relative to the contract volume, but we're still holding our own. The problem is, if you think we've got the same number of loads moving February this year to February last year, we've got a lot more trucks though. Got a lot of capacity. And this is just simple supply and demand, is how this plays out. So sideways there, Cass shipments has a bit more intermodal and LTL shipments in it. Again, you can get this report on the 4th of every month. Tim Denoyer from Act Research writes it. It's a really good report. Cass shipments index tells you what's the volume of shipments. It's about 30 billion in freight spend in this index. Cass shipments, you can see we're on par with where we were in July of 2017 as we came out of that freight recession, and we're on par with where we were in 2019. And we've been fairly flat over the last year though in terms of the volume of loads moving. All right, so again, I'm going to show you 3 slides that show we're kind of moving sideways and volume's flat. This is probably the best truckload demand index you could get for free. Professor Jason Miller at Michigan State University produces this. It's on a 45-day lag, but it's based on 41 freight-producing commodities that you haul. Right? Unlike Cass, that's got a bit of LTL and intermodal in it, this is purely truckload tonnage. So if you're in the freight business, subscribe to Professor Jason Miller on LinkedIn, and you can get this index. It's called the Truckload Ton Mile Index. And you can see the Great Recession in 2009, and then we went all the way up. We hit the peak in 2018, then we came down through the next one during the pandemic crash in April of 2020. And look where we are today. We are much higher than we've ever been, even though volumes have come off last year's peak. So I think he said very strong, I can't point at this, but if you look at the drop from 2018 through 19, they're very similar from 2022 to 2023. All right? Because if you ask me, what does the freight market look like? I would tell you it looks like 2018 did, but capacity looks like 2019 did. Demand was good in 18, capacity was very loose in 19. Right? That's how it's playing out right now. That's why there's downward pressure on rates. That's why brokers are looking to expand their margins, and you've never had to be better than negotiating than you have to be today. Right? You've really got to know your costs and hold your ground on this stuff. Right? Unfortunately, someone's out there hauling this cheap freight because I see it. I see the loads come through and think that's like, how do you run for 78 cents a mile from Seattle to Los Angeles? It's not even going to pay my food. Well, it probably would, but. So, the message here is 2023 volumes, expect them to be flat. Right, so I just showed you 3 demand indices that kind of suggest volume's going to go sideways and flat this year. And until that black line starts to, maybe flatten out a bit more and get a little bit more trajectory, we're not going to see spot market capacity start to tighten as volumes come up. Because seasonality, we're in the middle of seasons, right? Import season's at its low point. We won't see imports pick up till April. We're in between produce seasons. April's when produce starts to pick up in the southeast. Right, California flooding is going to have a really big dent on volumes out of Fresno and Monterey County and Salinas. Be very careful if you're running reefers out of the West Coast, because there's going to be some lower volumes coming out of there. It's the opposite of last year. We had lower volumes because of the drought. This year we've got lower volumes potentially because of the floods. So be very careful regionally with produce. What we're expecting is a slower start to produce season, but a pretty strong middle summer piece, right? So just watch the seasonality. So that's kind of how we're looking there. Let me take you into some of the rate trends. So where are we with spot rates? So the blue line is contract average national contract rate. So remember, these are the rates that carriers agreed to haul loads at, right? And we average them out across all of our subscribers, right? So we're seeing about 150 billion in freight spend over the course of a year. It's a lot of loads. So these averages are pretty tight. We exclude some of the high and low and come up with a really good average for what freight's moving at on a given lane. Start with 2010 and you notice that we were gradually increasing. You can see the bump in 2018, which was a good year for everybody in the trucking business. You can see volumes dropped off in the spot market, rates came down. There's one trend there, if you're not aware, be very close to this. Contract rates follow spot on a 4 to 6 month lag. Look how the blue line comes down slower than the red line does, and it comes down later, right? With rates, we kind of go up with the escalator and we come down with the stairs. Same with diesel prices. They never come down quick enough, do they? But they seem to go up overnight. So what you see is a lag effect. And you go right through this period here where we go from 2020 and the pandemic right through to January 22 when spot rates were at record highs. That period in that previous 18 months, you only had to look at all of the large carrier earnings calls where you saw all of the record profits being made. And it was the same for small carriers also. This was a pretty good period for all of us. But then rates started to fall off a cliff. When that red line started to drop, that's when diesel prices also started to go up. You had a perfect storm to squeeze the industry really hard. And if you didn't know your operating costs in the middle of 2020 and this happens, you're suddenly looking at fuel bills and maintenance bills that you can't jump over. Especially if you've got a used truck you paid triple for and you're a new entrant that's paid 30 grand per powered unit. That is a really difficult scenario to play out in 2022 and 2023. And that's kind of where we're at right now. There is still some capacity going out of the industry for all sorts of reasons. But you do notice the difference in the blue line and the red line on the far right. Contract rates are coming down slowly. Remember, contract rates are about 85% of all the loads being moved in freight. The smaller part of the market is coming down rapidly. So if you play in the spot market, you've got to go up and down, right? The point here is that if you look at the cycles are getting shorter. Look at the cycles from 14, 15, 17, 16, 17, 18, 19. They're getting shorter each time there's a market pitch change, but they're getting more volatile. There's bigger ups and downs. Now, we have no idea what the next shape of this next market cycle looks like. Does it go back to 2018 and it's less pronounced, there's lower amplitude? I have no idea. No one has any clue what this is going to shake out like. But there's one thing that's happened in the last year you've got to watch very carefully is the timing. We're already about 18 months into this freight cycle and it's looking like we're trying to find the bottom in the rates. And we're trying to and the market's trying to find equilibrium with capacity. Right? It's struggling to find its place right now at probably the worst possible time because this is the quiet time of the year. Like, we're not picking up until we get warmer and we get more steel moving, more houses being built, more produce being moved, all that stuff. Planting season, So we're a ways away from seeing this market start to take off again. Bit of tough sledding for the next probably 4 to 5 weeks, I would say. So that's dry van. Reefer, similar story. Again, contract rates follow, but not nearly. If you've got some contract freight work or you're hauling for a large asset carrier as a leased on owner operator, that's why you're seeing contract rates stick up a little bit higher. You can have copies of this. I see some of you taking pictures. We publish all this on a Tuesday after our DAT IQ show for free. So just go to dat.com/market update. I write a weekly report that's published every Tuesday for free. Right, you can download it and get all the copies of the charts. You should watch our show if you're hauling freight, 10 a.m. Easterns, DAT Freight and Analytics. You should watch our little show because every week I do an update on the market. And if you follow it week to week, you'll see where it's going. Don't just jump in one week and come back the next month. You miss too much. You've got to stay on this because this market's going to turn. You've got to be ready for it. Flatbed, similar story, ups and downs, right? Similar story, similar pattern. All right, so I want to draw your attention to this chart here. In our business, this is what we see between the split between contract and spot. Normally it's about 90-10 in an average market. It got as high as about 20% for the last 12 months, about 20% spot. In fact, on some weeks it was 25% of loads were moving on spot and 75 on contract. So it was a lot more spot volume. And if you had a truck, that's when the rates were going high. So, but it's come back to about 15% now as a norm. It used to be more like 10% in the spot market. It's holding at about 15%. So there's more loads in the spot market, but there's way more trucks. That's why price is coming down. Reefer, similar. Intermodal, very consistent. Flatbed, a completely different animal. Flatbed consistently has about 80 to 85% of its volume move on spot. So if you've got a flatbed and you want to play in the spot market, you've got a lot of one-way sitting under cranes and deadhead miles and project freight to the middle of nowhere. You've got to really know how to price that stuff. Because a lot of that red hasn't been negotiated in a contract the prior year. Because contract rates are negotiated in the prior year to be hauled this year. Right? So when you get a new load to a new destination for a new building, it's got to go to the spot market because no big carrier's got a rate for that market. So spot market is very different to the other two. All right, so let me talk about, so this is now, I'm going to talk about the contract market. Someone give me a time check. So I've got 7 minutes, okay. I could talk all day on this stuff and probably send you to sleep. This is contract rate data. So shippers send out all their loads via EDI, goes into all the TMS systems. All the carriers get it through into their TMS. They accept, reject, accept, reject, accept, reject. A year ago, probably 18 months ago, they were rejecting sometimes a quarter, maybe a half of the loads they were getting from shippers. And what happens when that load gets rejected by the carrier that's the cheapest at the top of the routing guide, who bid the cheapest on those 100 loads a day from Phoenix to Atlanta? If they reject it, it goes to the next expensive person. And they keep rejecting it, and it goes down the waterfall, and then it pops out into the broker market. That's how contract freight works, right? So these rates here I'm going to show you are the average of all the rates in all the routing guides. This is the average. This is the change. So dry van are down 1%. So if you take the pool of all the contract rates that have been pre-negotiated, moving on all those consistent lanes, all those large carriers, they're coming down slowly. Think about a bathtub. It takes a lot of water coming in to change the temperature in a bathtub. So active rates are like the water temperature in the bathtub. Replacement rates based on new negotiations are like the water coming out of the tap, right? They're hot, but it may take a while to move the total temperature. So active rates that are used repetitively, down 1%, 1% in reefer, 1% in flatbed, and about 1% in intermodal. So the active temperature, right, of all the rates used in the contract market, slowly cooling. Remember, spot rates come down quickly, contract rates cool more slowly. These are the new rates that large carriers negotiated with their shippers just before Christmas. right? And you would have heard about a lot of carriers going in, bidding their rates down to keep volume, right? And what we're seeing, new rates that are coming into our system used for the first time on a load, right? They're not the rate used on those 100 loads from Atlanta to Phoenix. This is the new rate for Atlanta to Phoenix we've never seen before, down 9% in the last 2 weeks compared to the prior 2 weeks, right? So these are in 2-week blocks, 9% in reefer, 11% in flatbed. So that's the blue line that I showed you on the chart. It's coming down slowly. All of our projections have contract rates bottoming out the middle of the year, right? And then they'll start to come back up again, right? So that's the projection there. Spot rates, though, they've fallen off a cliff. The average national rate was $1.70 a mile last week. That's the national average. I mean, heck, you've got to own your own truck and trailer and have a lot of money in the bank to pull any load for that rate. The national average of our top 100 lanes, though, was closer to $2 a mile. And regionally, though, regional dry van rates much, much higher. So these rates I'm going to show you are the national average for long-haul freight. Don't get scared by it, because that's the national average. There's a lot of opportunity on some of the other lanes that you could run. So that's the bigger picture. We've talked about this. All right, so here's the story of the last 5 or 6 years. This is the year-over-year look at the national average spot rate. So today we're at $1.70. We haven't seen $1.70 since March of 2020 as a national average across all of our 65,000 lanes. So you can see here, you can see the orange line is the pandemic. Rates crashed and then they took off. The red line started to cool off in early 2020 and then the polar vortex hit. And about 10% of the capacity went off the road during the polar vortex week and the market never stabilised. Rates then started to keep going up and up and up, all the way through 2021, and they came into 2022 and then the wheels started to come off then. So that's the purple line. And the black line is where we are today. So we are precariously close to the green line, which was 2019. We are trending, have been for the last month, at about 12 cents per mile above 2019 levels, which if your operating costs are like mine, they're up 25 cents a mile in the last year, 2019 is a scary proposition, right? So we've got to be very careful about what loads we're pulling for, operating costs, all those things. You know all those things. You wouldn't be here if you didn't know all of that anyway. So, again, I publish this every Tuesday on our show. You can get it for free. If you follow it, you can see the trend. We are forecasting out 35 days, and we are starting to see the market try and search for a bottom. I know this is going to sound weird, but it's trying to look for the bottom in the market based on the rates. And the rates are going to be based on where you guys find the bottom in what you're willing to haul freight for. And I put you all in that collective bucket, knowing that if you're here, you're probably not part of that crowd that's hauling that freight really cheap, right? That's why you're here. But what we're waiting for is when the market starts to tighten again and the rates start to come back up, which we think will be April, May, barring some national geopolitical catastrophe, right? So if I go through, again, I don't have time, but this is, if you follow load to truck ratio, this is the ratio of load post to trucks. It's got the tightest correlation of any data point to spot rates. On our show, when we talk about load to truck ratio for dry van, it's an incredibly strong predictor of where spot rates are going, right? So again, come out to the truck and we can talk more about this. I'll quickly go through this because we're going to run out of time. Refrigerated, pretty much the same story. Same pattern, rates are heading down, close to 2020. Flatbed is tracking very closely to 2018. So flatbed spot rates are tracking very closely to the blue line. And if you remember 2018 was mostly an industrial economy driven rate rally, and it was mostly flatbed that was leading the way. We had an oil price rally, changes in the tax code, a lot of economic stimulus. We were coming off 2 Cat 5 hurricanes in 2017, and we're still rebuilding the heck out of the southeast. So 2018 was a big year for flatbed carriers. The rates, everything looks a lot like 2018 did, although that little downward inflection in the black line last week has me a little bit worried. So anyway, that's where we sit with flatbed rates. I'm going to stop right there because I must be right up on time, and I see Adam over here. You up next? Oh, well, he just listed in. How's the time? I'm going to stop there because I got hours of this stuff. I bore you to death. But any quick questions? Any questions you got? Anything you didn't understand? Yes, sir. Oh, hang on. You've got to use this.
Is this thing on? Okay. Earlier you said that more carriers are entering or re-entering the market recently, despite rates not being so great right now and there being so many problems.
Right.
Did you say why people are entering or re-entering the market at this time?
If you're entering the long-haul sector of the industry, I don't know what you're looking at. But remember, those numbers are for anybody that needs a DOT number, so it's a box truck to a straight truck to a hot shot to a Class 8 tractor trailer. But it's the interstate longer haul freight task, right? And if there's been a lot more volume of LTL because they couldn't get a 53. There's been a lot more move on hot shots where you could take two part loads and put them on a hot shot because you had more availability. So there's all those sorts of things going on. I still think there's a lot of opportunity regionally though. When you look at some of our line haul rates regionally, it's a lot of opportunity for carriers because you're not talking $1.70 for dry vans. You're talking more like $3 a mile regional. But then you run into ELD problems with traffic and all that other stuff, so you've got to be careful too. Any other questions? Tuesdays, 10 a.m. Eastern, DAT IQ. Log in, subscribe to the show. Make sure you follow Professor Jason Miller at Michigan State University on LinkedIn. Subscribe to him on LinkedIn. Read every single thing he publishes every day. He's probably the smartest data analyst when it comes to macroeconomics on the truckload sector. Really good, solid guy. We share data with him bidirectionally. He's a really clever guy to watch. Other than us, of course. We're not too bad at it. All right, thank you very much for your time.